The purpose of this video is to explain 3 easy steps everyone can take to better trading. 3 easy steps. And we're going to take our time with this and we're going to explain each step. And there'll be no gray area. It'll be very specific. 1. Understanding risk management and the probabilities. And we're going to be very specific. It's black and white. It's no gray area. Number 2, how to trade the swing machine. Once again, no gray area. It's black and white. 3, where and how to place hard stops on every single trade. Once again, black and white, no gray area. I'm Bagadon, a Stock Market Caddy. Let's get started. Okay, in this segment we want to talk about the odds and probabilities. We all know that when we walk into a casino, the odds and probabilities favor the house, just about all the games. When we walk into the market, the odds and probabilities are very much in your hands, very much. But it's important that you understand what those odds and probabilities are before you start pushing shares around or contracts around. So let's just go through this little example to discuss odds and probabilities of flipping a quarter. The probability of there being a heads or a tail on any coin toss is 50-50. However, if we throw the quarter 20 times, it does not mean that we're going to get 10 heads or 10 tails. It could be lopsided just due to a cluster. And there is a probability over time of running into these clusters, a cluster of heads or a cluster of tails. But what we do know is if you toss this coin more and more, 100 times, 1,000 times, the probability that it's a head or a tail over the entire sample is going to be very close to 50%. Now the question comes down, if that is a strategy, if I have a strategy that wins in the market 50% of the time, can I make money? And how much should I risk? So here in this coin toss, to draw this home, we invite you to think this through. If you risk $100 on every toss that you lose and make $300 on every toss you call right, what hit ratio do you need to make money? And it's fairly simple. If your win-loss ratio is just 30%, meaning you only win 3 out of 10 times, you will become a money-making machine. Because your winnings will be $900 versus your losing dollars of $700. Your profit factor would be 1.29. Of course, if you can increase that ratio, either increase that ratio or put yourself in a position to make even more than 300, 500, or 1,000, then you can trade and make money over time and truly become a money-making machine. But now we got to talk about not just the odds and probabilities, we got to talk about risk management. And we're going to do that next. Okay, in this segment, we're still talking about the first step. Okay, we're still talking about odds and probabilities, and now we're talking about risk management. In the earlier section, we're talking about odds and probabilities. What we're trying to drive home is that it isn't so much the hit ratio. It's not winning 8 out of 9, 9 out of 10 times. That really is irrelevant. The hit ratio may feel good, but it doesn't win ball games. What we need to be doing is we need to be risking one token to make 3 tokens or more. Okay? We don't want to be risking 3 tokens to make 1 just because it feels good, right? I mean, if we're chasing a hit ratio and we're winning 9 out of 10 times, but when we lose 3 tokens to make 1 token, well, you can do the math. We lose money, a lot of money. You become a losing machine. You just can't win. You're not putting probabilities on your side. So we need to understand that, at minimum, we want to shoot for a strategy that is at least 50-50. Sometimes it might run a little higher, sometimes it might be a little lower, but at minimum, we're only going to risk 1 token to try to make 3, and sometimes we're going to make 5, we're going to make 10 tokens, and every once in a while we might make 20 tokens. But we're not going to lose more than 1 token, and we're not going to lose 5 tokens, 10 tokens, or 20 tokens on 1 trade. We can't do that, no matter our account size. And so we're going to talk about how we do that in a follow-up segment. This segment is on risk management. I don't need to know what a trader has for their risk capital. I really don't need to know. But that trader needs to know. And that trader needs to understand that risk capital has to be protected. Not to the point of being fearful, but being respectful of your risk capital. Now, when you put on a trade, you do not want to risk. You don't want to risk no more than 1% on any one trade of your risk capital. No more than 1%. We start with that. Now, I do not subscribe to the school of thought that you have to have a large trading account to become a trader. I don't believe in that. What I do believe is that you need to, have good, solid fundamentals, and that folks can, over time, grow a very small account and become very successful in a very mechanical, measured way over time. I do believe that. Because it may be true that, someone can take a $2,500 account and grow it over time, or even get lucky and grow it into $100,000. But it's also equally true that a person with a $100,000 account can blow it up. And one of the ways is not appreciating this notion of not risking more than 1% on any one trade. So if you have $100,000 in an account, you wouldn't want to risk no more than $1,000 per trade. Now, it doesn't mean that the stop should automatically go to 1,000. The strategy that you're running and the tools that you're using, quite frankly, would be the way we're trading intraday would be way too much risk to even do. So you wouldn't even need that. So I don't even think you need that type of capital. 50,000 though, 1% would be 500. Once again, I think that risking 500 is much more capital, much more leeway than you need to give for futures, for the vast majority of futures trading intraday. 20,000 is 200. I think that is a very comfortable stop loss, a risk token for trading just about any of the futures on an intraday basis. That is a good spot. 10,000 is 100. Now, just because it's 100 doesn't mean that you can trade all of the futures. And let's talk about the NASDAQ, for instance. And to dramatize this point, I'm going to slide back and talk about the 100,000 account. TradeStation or any brokerage these days will give you upwards of 4 times the amount of money you have in your account to trade intraday. So theoretically, you could trade, if you had $100,000 in your account, you could trade intraday as much as $400,000. And I ask you, would you do that? Would you do that? Would you go 400%? Would you go 200,000? Would you go 150,000 and use the whole thing on one trade? And if you did, are you prepared to lose $5,000, $10,000? That would be 10%, be a big chunk of your trading capital. I think to do so would be reckless. So when we get down to these smaller accounts, just because TradeStation will enable you to trade 4 times that amount doesn't mean that that's what you want to do or that is the responsible thing to do. Just because they give you the rope doesn't mean, you should use that rope to hang yourself. It's very seductive. And it's the mistake most new and novice traders make. How little can I put in to open up an account? Wow, they're going to give me, at $5,000, I could trade, 3 contracts, 2 or 3 contracts of the ES or the NQ, upwards of $20,000. Wow, wouldn't that be awesome? And all I have to do is just hit on 2 or 3 trades, and I could double my money to 10. And then I could just keep on going and going and going. The only problem with that is when you use that type of leverage, if you lose $1,000 on a $5,000 account, 20%, the next time you're not going to have the capital to use that much. It becomes a fool's errand. You over leverage. So at 5,000, you really shouldn't be risking more than 50. And at 2,500 on any one trade, and you really shouldn't be risking more than 25. Okay. All right, so Don, I'll trade 1 contract of the NQ, and I'll set my stop at 50. Well, it doesn't quite work that way. Yes, TradeStation will enable you to trade 1 account, one contract, and technically you'd be using margin less than this, but it would be still significant. But $50 doesn't mean that because that's your stop that is enough room to trade a particular market. Give you a for instance. Let's say you're trading stocks and you have so much money to trade stocks. I might like to have a $1 stop on a given stock. Can I trade Amazon or Google with a $1 stop? No, can't do it. The normal bid and ask, the difference between the bid and the ask on any given trade could be $2 or $3. If I trade it and just get a few shares, and I set a $1 stop, I'm just going to get stopped out all the time. So what to do? Well, if you're at 20 or higher, you're going to be in good shape, to start out, and to be not putting too much pressure on your trading account or on you. If you're at 10,000 or at 5,000 or at 2,500, you really have to give thought to what market you're trading. Now at $100, it's even there, it's going to be pretty tight. There may be certain markets, maybe a few of the currencies you could trade. But to trade the NASDAQ, the NQ, I don't think you don't have enough width in the trade to withstand the noise. You'll just keep getting banged out. So if you can't do it here, you can't do it at 50, and they say, well, geez, then I can't trade. Well, you can today, and that's the fortunate thing. You can if you go down to a micro contract. And you might say, well, Don, this is going to take forever. Well, you should be boring, right? If you were trading, you had 100,000 account, you'd probably be bored just with a $200. And that's a good thing. So if you're trading down here at $2,500 and you trade one micro on the NQ, and you're exercising disciplined entries and disciplined exits and you would be risking $25 to make how many? $75. It really won't take you that many trades, and you can do the math, to get your account from 2,500 to 5,000, and then from 5 to 10 and so forth. That's how you build an account over time. And it doesn't take that long. And I'm not going to do the math now on a spreadsheet, but you can do the math yourself. How many trades will it actually take? And just because we say that you should be risking 25, now you would never back off of that. It doesn't mean that you lose 25 every single time. Maybe you lose 10, maybe you lose 15, maybe you lose 20. But you're not going to lose more than 25. And you're going to be targeting to make 75. But sometimes you're going to make 50. Sometimes you're only going to make 25. Sometimes you're going to make 100. Sometimes you're going to make like 300. Because the way that we trade, and the way that we're going to show you specifically, is we don't want any negative, but what's not going to happen is you're not going to lose more than 25 on any one trade. You're not going to lose $250. Okay, that would be 10% of your capital. It would put too much pressure on your trading account and too much pressure on you. See, the mistake that people make, new traders in particular, they make a few things. They're undercapitalized for the amount of risk that they're putting on. They don't understand and appreciate what margin can do. Margin is a beautiful thing. When you know what you're doing and you're trading in a disciplined fashion that's been honed, it's a beautiful thing. When you are just flinging contracts around and you really don't know what you're doing, and the worst thing that happens is you get 5 or 6 clusters in a row that work, and then they don't work, and you don't understand the probabilities, you don't understand the risk management, and you hold on for just one trade and it wipes out all of that profit and maybe a good portion of your trading capital. And they don't learn that. And they just keep repeating it. And the thing of it is, they could have really good trading skills. They might even have a pretty good strategy, but they're just not exercising, the stops that we're going to show you and how to do it specifically, and they're not executing in a disciplined fashion. And they also might be trying to chase a hit ratio. They want to win, they want to feel good, they want to win 7, 8, 9 out of 10 times. And not realizing that I only got to win 3 or 4 times, 5 times out of 10, as long as I'm, honoring the probabilities and the risk management. And so what they do is they just keep doing it over. And so if you have a $2,500 account or $5,000 account, and you put on an NQ contract, a mini contract here, which you can do, they'll let you do it at $2,500. They'll just about let you do it. That would be comparable to trading $400,000 on a $100,000 account, and yet people do it. And it would be like trading $200,000, on a $100,000 account on a $5,000. And you just lose 1 or 2 trades, 1 or 2. The account gets significantly damaged. You lose 10, 20, 30% in just a few trades. And you're like, man, I coulda, shoulda, woulda. And then, honey, I'm going to put in another $2,500 and do the same thing over again. And the same thing over again. And the same thing over again. And the truth of the matter is, even if you hit a string of luck, let's say you get a cluster and you get lucky and you hit 20 trades in a row and you grow a 2,500 account to 20,000. And if you haven't learned and understood this lesson about odds and probabilities in risk management, this 20,000 will be back to 2,500 in not very long time. Not very long at all. So it's critically important. But please understand, just because your stop is 25 and just because it's at 50 does not mean that the market owes that to you. You do need some help or some appreciation, some practice to understand how noisy a particular market is and what kind of breadth you need to trade. And at the moment, much of the contracts that I'm trading today, I can get away with approximately 200. This comes under a little bit of pressure on the NQ. Sometimes it's 250, 275. The oil mini contract I can trade with about $180 stop, thereabouts. But the thing that's different in my trading versus others is I don't have trades, and we're going to talk about locking in the stops, where I lose on a single trade $500 or God knows $1,000 or $2,000 or $3,000. That doesn't happen because on any single trade, and I do pause between trades when I'm actually, trading both mechanically but with some discretion. All right. And even if we're not going to talk about running strategies here, but it also applies to a strategy. If you run a strategy and you set your profit target at $50 and you set a stop loss at 300, you are going to lose money. You might as well just write them a check. You're going to lose money. You'll be doing it, trying to chase a win-loss ratio. It's not about a win-loss ratio. It's about that profit factor. So very, very important. So in these last two segments, we talk about the odds and the probabilities, and we talk about the risk management and the size of your account. And it has to be practiced. Now we want to talk about how do I trade using Swing Machine? How do I trade using Swing Machine to give me the greatest likelihood of getting, Don, it's great. You say that, I should be shooting for 3 tokens or more. But how do I do that? How do I know that? Okay, and that's also part of what you're going to rely on, what you would have had during our jump school program. But Swing Machine, there's a particular style, technique that you want to practice and employ. In the beginning, in hindsight, I tell folks, I'd give them a framework and kind of let them find their own. Today, we're not doing that. We're starting out with everybody to say, this is the best way to trade the Swing Machine. And then if you want to do something alternatively down the road as you get really good, and as long as you understand what you're doing, we'll leave that up to you. But this is the way to trade the Swing Machine, and we're going to show you next. Okay, Swing Machine. This is how we have had, if you don't have this, we also have a new column for Swing Machine, which is the next best trade. But if you're watching this video, it's with the assumption that you have been through a Jumpstart program, you have some familiarity with Swing Machine, so I'm not going to explain all the nuances here of Swing Machine. I'm just going to explain a couple of the changes that we've made, and also, more importantly, how to trade this. When you turn on Swing Machine in the beginning of your trading day, it's safe to say that you're in a flat position. By the way, this is in sim right now, and this particular trade that's up here is running off of the machine. Okay, so I'm not worried about it. You don't have to concern yourself with it. that you're not in the trade. So you might look over here if you're not in the trade, and Swing Machine will tell you that the next best trade at a 1 minute level is going to be a fade on the NQ, and you might want to wait. Okay? But what the purpose of this segment is to share with you how best to trade Swing Machine. Swing Machine is now set up with 1 minute, 3 minute, 5 minute intervals. 1, 3, 5. 1, 3, 5, all the way down for the 6 markets. At a later date, when it's on your equipment, you might set them alternatively. But the technique is the same. What we want folks to do is to get on these little trends. Just as the market has had a very big trend for 10 years on a monthly basis, right? This big, huge trend, right? There are little trends during the day. We call these little microbursts trends. What we are teaching folks to do is when the 5 minute trend is long, okay, as it is now, when the 5 minute trend is long, and this went long at 12 p.m. today, and it's up $125. You do not even consider going short on the 1 minute. Don't even do it. Okay? You do not do it. You only take trades in the direction of the 5 minute. So, 29 minutes ago, I have to reconstruct this because we don't have exactly what I might need to show you. So we're going to bear with me and let me reconstruct this. So at 12 o'clock on the ES contract, it goes long, and you're not in the trade. You weren't here at 12 o'clock. You come in at 1 o'clock. At 2:19, the 1 minute goes long. Do you take that trade? Yes, you take that trade. Why do you take that trade? Because the 5 minute is already long. Okay, so you do take it. When do you take it? This, as you know, will light up white with a long entry. Do you take it then? No, you do not take it then. You wait until that white box turns green, is in a what we call a confirmed position. There'll be a Roman numeral 2 here, green, and it'll light up white. And then you go long. This is purely trading from the Swing Machine. Now, your stop off of the Swing Machine. We're going to talk about stops again on the chart. But your stop from the Swing Machine, you are in this trade long. If the 1 minute goes into a dip, do you close? No. You could, but that's not your hard stop on the Swing Machine. And we would encourage you not to trade that frantically. If it lights up white with a short entry, would you exit? No. The only time you would exit is when you get when the short entry confirms and the box turns red and you get a Roman numeral 2 here and it's shrouded in white. Then that long trade that you put on at 2:19, you would take off. That is a stop loss, okay, off of Swing Machine. So that is how you enter. And what you will find is you will be getting on trades that last sometimes, and a lot of the times, a good long time, okay? Now, does that mean you can't take your $150? No, that's a profit target. If you want to take your money, you can take your money. But remember, okay, remember the token business. When you go into any one of these contracts, we can tell you generally you have to get a feel for this when trading yourself. But when trading a mini contract, if the 1 minute goes against you, you're probably going to lose 150 to probably, hopefully, again, it's, but hopefully not much more than 200. Once we're up 137.50, it's very, very unlikely that you would, if this thing turned around, that you would lose anywhere near that. All right. So the stop level is if you are going to exit off of this, box turning red, which is what we would be instructing for stop loss, then you wouldn't be losing nearly as much. All right. Now, as far as a profit target goes, if you want to take your $200, you can take it. All right. At least it is the width of what you were approximately risking in the beginning. All right. But it would be better that you do your best with the help of Swing Machine to try to stay in these trades and try to do what? Try to get to 400, 600 or more. And if you keep doing that in sim, day after day, week after week, and you just keep going in the direction of the trend, you are going to start seeing trades that are $1,000, $1,500, $2,000. Those are the types of trades, we have been having. But that is how you do it. Now, let me look here on as an example. I'm going to see if there's an example. Well, let me give you this as a thought to consider. We talk about hurricanes that hit Florida, God forbid, right? Every hurricane in Florida starts with a butterfly fart in the Sahara Desert. Every single hurricane that hits Florida started with a butterfly fart. Some little butterfly squatted down, farted, kicked up a little puff of sand grew into a thunderstorm, comes across the Atlantic 3 weeks later and hits someplace in Florida, God forbid. Every single one. But does every butterfly fart in the Sahara Desert turn into a hurricane? And certainly one that turns into, one in Florida. Does every single butterfly fart? No, it doesn't. So these 1 minute trades are butterfly farts. They are butterfly farts. And all we're saying is if you take this butterfly fart and it's in the direction of the steering currents, this little 5 minute hurricane was already had its direction. Okay, it's not really a hurricane, but we'll call it a hurricane, right? A little 5 minute hurricane. It's already set its direction. It's already steering where it's going. So why wouldn't you take it? Why wouldn't you go with it? You would go with it, right? So if the 5 minute is headed in one direction and the 1 minute butterfly fart wants to go in the other direction, why do you want to do that? You don't want to do that. The only time you might want to pay attention to that is if I'm up $250 and I'm trying to stay with this trade. If it's suddenly, and I stay with it, it suddenly starts to go the other way, then, I might use that as a rule to exit. Okay, so we're making the video, and I just had to answer a question for somebody in the room, and we were running the strategy, and they were saying, God, I can't believe the strategy was down $755 and it's now up $500. That's incredible. And we're just explaining that you just can't come in and not have an appreciation for your account size, not have an appreciation for the risk and the probabilities, and just plug in a strategy and think that you can run this type of strategy that could have a $755 drawdown with maybe a $10,000 account. It's just not realistic because, if you lost that much money or more, you would have lost $10,000. But this could have been run very comfortably with a micro contract. Instead of it being $750, it would have been only maybe a $75, depending upon one's account size. So, and then there are different strategies, right? There are all different strategies in different markets. But this basic concept of understanding the odds and probabilities and understanding your risk capital, it's critically important to everything that you do. And so, but here, now back to the swing machine, which is what this segment is about. We were here when we were doing this, and I think we were talking about this 1 minute. So this 1 minute is now up $412. There's really no reason to come out of this trade. It's in the direction of the 5 minute. But if you want to take your 2 tokens, and you go ahead and you take them. You just don't go the other way, and you don't go back in, and you just got to wait, and you let them cycle out. But I was talking about this notion or this concept of the butterfly fart. Now, what can happen is this. Let's see if we get an example. All right, so we do have an example here. The 1 minute on oil is long. All right, do I want to take that trade? Well, no, not the way I described it. Because why? Because the 5 minute is short, and it's been short since 135. All right, but let's roll forward, and we don't have the time in making this video to see how this is going to play out. But let me roll this out, because this happens all the time. Let's say that this 1 minute does, in fact, it's a butterfly fart that's going to turn into a 5 minute long hurricane. And this thing, in the next 20 minutes, this thing runs up, and the 1 minute is up $300. And lo and behold, the 5 minute confirms long. It goes long entry, and then it confirms long, and we get a shrouded number 2, and it's white, and it's just starting. You're like, dang it. If I had only gone with that butterfly fart, I would be up 300 plus. I'd have the 5 minute hurricane at my back, and I'd be making a killing. Well, what you can do is this, and that happens. That happens a fair amount, because every five minute generally will start with a 1 minute. Now, sometimes they start right together, and there's no discrepancy. But several times, or many times, I don't know if there's a count for it, the 1 minute could be up $300, $350, and the 5 minute is just going. And the 5 minute confirms. Can you enter on the 5 minute? Yes, you can. You can take that trade and say, I'm going with that trend. And you go with the trend. What is your stop on swing machine? Your stop will be if the 1 minute reverses, goes into a dip, goes into a short entry, and then confirms with a short, then you exit. That would be your exit. But Don, I don't want to lose $300. You won't. Okay, generally. Okay. Having done this, all of us, you generally, you have to practice this, okay? So this is in general, okay? I can't say definitively, every single time. But our experience has been, when the 1 minute does turn around, the loss would be much smaller than the 300. So although it's printing 300 here, we don't want you to shy away from going with the 5 if you want to go. Just understand you'll exit with the 1. You won't exit with the 5. Why? Well, you could if you have the risk capital. If you start playing, now we're recommending the new person getting their feet wet, looking to keep the odds and probabilities and the risk low. We recommend that you play the 1 minute off of the 5. And that if you do enter on the 5, you exit off of the 1. So you're staying at the 1. Down the road, when your experience increases, when you're more confident, when you have more risk capital, and you understand, and you've watched this for days, and you have that experience, can you enter on a 5 minute? Yes. Will your drawdowns be bigger on a 5 minute? Yes. Will your losses be bigger on a 5 minute? Yes. Will your profits be bigger? Yes. Will the odds and probabilities change? No. Right? Is your account size big enough to trade the 5 minute? I don't know. You would have to answer that. Then down the road, I could show you the 1 hour swing machine. I could show you a 15-minute and a 1-hour swing machine. They got huge profits. The 1-hour swing machine has almost today, just in the last couple of days, has close to over, has thousands of dollars, $10,000 to $12,000 in profit. Do you have the skills yet to trade the 1 hour? No. Do you have the capital to trade it? I don't know. Okay, but you don't want to start there. We start with baby steps. We start with a really small increment. And why? We're trying to keep the risk up to your account as low as we can. You want to keep it as low as you can as you learn. And then as your account grows, do you change your trading style? No, you don't change it at all. You still keep doing exactly the same thing. It's just then, instead of trading just 1 micro, you can trade 2 micros. You could trade 5 micros. You could maybe trade 7 micros. Maybe then you can start trading the mini. And you never look back because you're trading exactly the same way. And when you get that account to 50,000, are you going to leverage, $150,000 and take a 5,000? No, you're not going to do that because you already know what that means and what comes of that. That's how you want to blend what you know about probabilities and odds, and also, good, sound, fundamental risk management, and how you want to use the swing machine. I can't tell you how many times during the week these 5 minutes are up $1,000. Now, you may say, hey, I don't really want to do the one. I just want to trade the 5 minute. Okay, if you have, the necessary capital to put on a micro on the 5 minute, you're going and you set your risk capital. You should do fine. Okay, you should do fine. All right. So I'm not going to beat a dead horse there, but that is how we get on. So when this is solidly green, we're long. We're not trying to go. We're not short. And if you see a dip here and say, okay, I want my $325, fine. Go ahead and take your $325. The trade is done. You're done. Okay, and you wait for the next one. And I'm not even taking the as you know, we get re-entries, and I'm not even taking the re-entries. All right, so that's how to trade swing machine in the direction of the trend and how you manage your risk accordingly. If you have any questions on this, let me know. Now, you can still use a chart. And if you have a problem, which some people do, taking the loss or being wrong, and sometimes you're like, oh man, I know that thing just changed to a short entry, but I can't put I can't bring my mouse to close the trade. I just can't do it. And you're not executing. That's where we need to get mechanical. That's going to be the next segment, and I'm going to show you how to put the stop on the trade every single time. And it's there, and you don't change it. And let's do that now. Okay, so in this segment, I want to show you how to set the stops. Now, I explained the stops if you're watching the radar. I explained to you how to enter. If you have any questions on this, call me. Let's review it. For anyone watching this video, especially a member or level 2 member, I will spend whatever time is necessary, a half a day, a full day, trading side by side to explain the nuances. It's up to you to reach out to me, though. I'm not going to pester anybody. But it is, just the way we explained, and the exits are to be honored. Now, if you think there's any possibility, and in fact, whether you hesitate or not, sometimes the market can move faster than you can find your mouse. So I think it is a good idea. We're going to come here. And we're going to turn on, no, we're not going to use this one because I already got a trade in here. So we're going to use this tool here. Now I'm going to demonstrate how to use this chart trading tool. But let me just show you a couple of things here that are on this chart. This is our divot marker. And this is how we prefer to have our chart set up. You have a chart set up here. You have 1, 3, 5 minute. You have a chart trading tool here. You have everything you need right in front of you. This is a Renko chart. If you need help sizing the Renkos, please let us know, because there is a specific technique for doing that. I'm going to bring the Renkos back into view. The idea of this is pretty simple. When the green bricks are going up, you do not want to be short. When there are red bricks, you do not want to be long. Unless you have so much profit in a trade and you think it's just a pull back or a pull up and the bigger trend is going to continue. And we'll help you decide that by, if the green bricks are above the divot tool, ideally you want to be long. Green bricks. Each one of these bricks is $80. $80. When the red bricks are under the divot tool, you want to be short. That difficult or that easy. If you cannot see the trend, come here to the format tool, flatten out, clear out the bricks, and see the trend for what it is. Up, pull back, up, pull back, up. Higher lows all the way, right? Higher lows. Took the low out, pull up, couldn't take out the high, we go lower. You see that? Let me get a marker just to make sure that you see it. We're looking for this sort of action. Up. This would be, take this with a red marker. This would be down, little pull up, down, get the idea. Okay, just for the trends. Now, these dots are our pivot dots. When a pivot low is higher than a previous pivot low, you get green dots, and you want to be thinking about buying. When you have lower pivot highs, you get red dots, and you want to be thinking about selling. When the histogram is above the zero line, you want to be thinking about buying. And buying the dip. When the histogram is below the zero line, you want to be thinking about selling. If you can't see the price action above or below the divot tool, you can see it here in the pocket caddy. It's green when it's above, it's red when it's below. Green when it's above, red when it's below, and when it's in chop, it's in yellow. This was some chop here. Okay? It's that difficult or that hard. Now, the beauty of having the bricks there is you can have a defined stop. What do I mean by that? Well, let me show you what we do each and every time. I'm going to lose this little tool here. Now, I'm going to short this. It's not really a good short, but it is lighting up here short. But this is so long. So this is not an example of a trade, other than it's an example of using this tool. You want to use this tool on every single one, and so I'm going to short this to demonstrate. And you can see here I'm going to move this little stop just above that swing point, and here is my profit target here. How much am I risking here? It looks like it's $262, so it's a little bit more. If I want to tighten up that stop to 200 and I can't see it on the window or on the chart, So let's come up here and see where that stop is. There it is at 262. I can take it from here, push it down to 200. Puts me right in there. The width, if I put the bricks in, it's 2 bricks. So before I do this, I know I'm going to be risking about 2 bricks, 2.5 bricks. So I have to think that I have the likelihood of making at least 6 bricks, right? 3 times the 2. This one trade I probably would not have taken because it was against this. But I can also move this up here and at 5 1/4. Every single trade we put on, we use the chart trading tool. Even if we're going to exit here, if this goes long again, I could exit and I could cancel these chart trading tools and just exit, and maybe I only lose $75 or $100 or $125. But at minimum, the stop loss is on. I'm not going to lose more than 200. There is no way in hell I'm going to lose that much, or lose 1,000 or something because Trump tweeted this or tweeted that. You cannot get jammed. Okay, we don't want you getting jammed into a trade, and this is how you don't get jammed. You've got to do this every single time. Now, just because I don't want to lose $50 doesn't mean I can move the stop down to 50, less than a brick, because I'll get tagged out every single time. This is likely to get tagged out anyways. Why? Because the 5-minute really wants to go up, and I'm pushing at the end of the day. But we'll see what happens. So this is key. Okay? Key to managing your risk and also putting your probabilities on your side. How so, Don? When you risk $200 and you run up 100 or 200 or 300, move that stop loss proportionately up. So if you're up $100 in the trade, bring that stop loss that was set at 200 to lose just 100. And when you're up 200, move that stop loss to just over your entry price, whichever the direction it is. And when you do that, you now have a free trade in that it's no risk. You're not going to lose. Now, you could get stopped out 5 or 6 times. Who cares? As long as you cover the cost of the trade, 10 to 20 bucks. Don't care. Remember the probabilities. Remember the earlier segment. If you get stopped out 5 or 6 times, that's just fine. You are forcing the market to pitch to you. Okay? You're not swinging wildly at every pitch that the market throws. You're going to choose the pitch to hit. And when you do, you put your parameters on, and then you go from there. Okay? But so we don't swing at every single one. But when we do swing and we think it's a good one, we put the parameters on. We put the stops on hard so that they're on here. And then also, if it goes here and I see it go south and this goes green, if I'm not already out, chances are I would be out, but if I'm not already out, I can get out. And then if it goes in my direction, I grab that stop and I'll drag it to just over my entry and give myself now a free, a free trade. And then we just swing away at that point. That's it. Now, there are things to learn about this chart trading tool. If you're in our level 2 program and you don't have any of these proprietary indicators, please don't hesitate to ask us and we'll get them to you. But you should have them. You got questions on how to work this? TradeStation has a great tutorial, much better than what we can do. But if you're struggling with it at all, any aspect of it, how to set it, there are some nuances. I am more than happy to review this with you and go over and how to use it. But you want to use it on every single trade. We have got to take the negative outlier off. Okay, we don't want, we can't afford to have any, we're using a pitching metaphor, but we don't want to have any passed balls. We got to block, if we have a wild trade or a wild pitch, we got to block it. We don't want anybody scoring any runs on us. So that's how we block it. That's it. Catcher goes down on his knees, blocks the pitch. If it's a wild trade and goes against us. I don't think this trade, was set up for us, but that's not what we were trying to teach or show. So we're going to go back here to the radar, and that's really it. We're going to come back and review, but we've been talking about 3 steps to better trading: the odds, the probabilities, how best to use Swing Machine, how best to use it, and then how to take the passed ball, the negative outlier, call it whatever you will, the quadruple bogey, the 10, on a par 3, how to take that off the table, completely off the table. And that's how we do it. The last thing I want to talk to you about is just a comment on trading and a comment about strategies, and then we're going to close. Okay, what I wanted to wrap up with, I wanted to show you, we've been running in simulation today and showing everyone a strategy that's been running on a 3-line break chart. And this is a strategy that has been doing pretty well. But the thing I want to show you is, I want to show you it was in the NQ. It had one trade this morning and it made $1,110. Okay. Let's go back to the strategy, and this is its second trade right here, and it's right here. This is the one that we all put on without any regard to anything, but we'll leave it there. It'll get stopped or whatever. But this one here had a drawdown of $755, had a run up of 580, and it's at 145. Running strategies is a beautiful way to go. It really is. But you can't take this for granted. And you cannot run strategies if you do not understand, and we're going to come back, if you do not understand your risk management and the probabilities, I think that you can do much, much better running a strategy if you know how to trade and interpret the Swing Machine. And I think, as well, understanding, where to place hard stops, or at least intervening maybe, and how to interpret, but particularly these, this one here in running a strategy. If you don't understand this, you will self-sabotage the strategy. If you are trading from the seat of your pants and trading trying not to lose, you will lose. And that's what, many retail traders and novice traders will do. They're trading not to lose, and they want to win, and they don't understand the probabilities, and they do things that just self-sabotage themselves. And we could even have a strategy running, and it would, you would self-sabotage it. One of the traders, which was honest, he says, Don, I cannot believe that strategy had a $750 drawdown. Now the SOB is up $500. I cannot believe it. So what he's basically saying is that, which was good, that would have really, really tested his patience and maybe his risk capital. It would be too much to take. So when you understand the risk management and the probabilities and how to manage it, it doesn't mean that it's a bad strategy. It just means that it's over leveraged. and maybe it would be better to run a different market, or maybe run just one micro, and let the strategy in the swing machine kind of coach you and teach you how to stay in the direction of the market and how to control your emotions. But with that, we have tried to impart to all of our members, base members, but particularly our level 2 members, how we approach the markets day in and day out. In the end, this is a very individual game, and it's just as everyone has their own personality, everyone has their own personality of trading. If you think things, we're certainly open to questions and challenges, but if you think that, this just doesn't work or whatever, I don't know where we'd be amiss. But the other thing is also true. We're not here to try to change anyone's personality at this point. We're trying to help folks recognize their trading personality, and sometimes they can be so close, to really getting it done. And they just need a little tweak or a little something to understand this is what I need to do, and they're off and running. On the other side of the coin, excuse the pun, but on the other side of the coin, it's okay in this instance to ring the bell. The Navy SEALs. This isn't the Navy SEALs. It's not meant to be the Navy SEALs. But it's okay. Not everybody is meant to be a trader. If it was easy and just, fire up an account and load it up with money and start pushing things around, as they say, everybody would be doing it. It isn't an automatic. But if you can grasp these what we think are 3 easy steps, I think your trading will be much better. But there are some tools that you need to learn. You need to, you still need to use the chart trading tool. You need to know how to use it. You need to practice. You need to understand how to set up the Rincos. You need to use the tools, and it is time consuming. You have to be in front of a computer, so you have to enjoy that time. And you also have to understand, maybe also too, just because the market is open at night doesn't mean that you should trade at night or in the wee hours. The markets are very thin and very susceptible to very harsh, dramatic moves. Much of what's going on is going on during the course of the day. And so with that, we're going to say thank you. If you have any questions at all or anything that we can help you with, by all means. And like I say, it's totally okay, to say, hey, this just isn't for me. And to ring the bell and there's other ways to make money in the market from an investment standpoint. And intraday trading and intraday trading futures and swing trading, it's very compressed, right? It's very compressed. And so the learning curve, there's still a learning curve, but it's very sharp and it's very steep. And but you can take a lot of what you will have learned during these Jumpstart programs and even this video and apply it, because it has very good, sound, basic fundamental trading investment criteria that you can apply to maybe a much slower time frame. And then and anywho, so we won't beat a dead horse. We wish everyone the very best who has heard this video, and you're always welcome to call me, 813-758-8263. If you are a member, you jump to the front of the line. If you are a level 2 member or a Jumpstart participant, you jump in front of that line. And I will do anything and everything I can possibly do to demonstrate how this is done live on a weekend, on a Saturday morning, Sunday morning. All I ask is that you give me, some advance notice. All right? And if there's anything else we can do, don't hesitate. But I wish everyone the best, and good luck.